Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to go over the number one velocity banking myth. And I've seen angry comments about this recently because I made a video kind of similar to this. But the number one myth, in my opinion, is that you should replace your mortgage with a line of credit, right? And I'm just going to go over a few observations, some few talking points. And some people say, "Oh, you should just replace your mortgage with the line of credit, or you should replace any loan with line of credit. Loan bad, lines of credit good." And I want us to kind of get away from that type of simplistic thinking, right? So if you decide that you're going to place a low interest rate mortgage, a higher interest rate line of credit, it does save some interest if you use velocity banking, but it's not going to save that much. In fact, if you do extra payments or chunking, and if you don't know what chunking is, it's like incrementally moving pieces of the line of credit to your loan to the line of credit. That's going to save way more interest than what's it called? Way more interest than replacing your mortgage with line of credit. And so if either way is fine, extra payments or chunking. But one of the things I want to mention is that chunking is almost resistant to a high interest rate, right? Whereas you could have like a 30% credit card and do chunking versus a 9% line of credit, and you place the whole mortgage, and you'll save much more doing the 30% chunking, right? Number three, I honestly think that velocity banking, the benefits of velocity banking are very over exaggerated. And again, I might be wrong about this when it comes to you having one debt like a mortgage, right? Like, I like to do a lot of demonstrations where you have various types of debts, like multiple credit cards, a couple loans, and a mortgage. And pretty much every single demonstration, the mortgage has been paid off last. And the reason why it's been paid off last is because it provides the least amount of cash flow for paying it off. So if you ever heard the term cash flow index, that's a term made up by Garrett Gunderson. So we could look up cash flow index right now. And then I'll be at the wealthfactory.com. So this one right here. So basically, all that means is you get a number. Oh, let me scroll down. So you get a number, you get the loan balance divided by minimum monthly payment, and the mortgage is usually a high number, meaning that the loan is efficient. And if you ever take a look at this explanation, it's telling you don't pay off anything over 100, right? So this is why if you ever do the cash flow index and you have a bunch of loans and lines of credits and you're paying off debt, you could think of this as a ranking system, and anything over 100 you want to leave to the very end, all right? Or you want to leave the highest number to the very end. So let me go back here. Okay. Another thing that people say is, oh, loans have amortized interest versus lines of credit have simple interest. They're pretty much calculated the same way. Maybe there's a slight nuance difference, but they're pretty much calculated the same way. A line of credit takes the average daily balance, multiplies it by the interest rate, and then divides it by the number of what's it called days in that month, right? Whereas with the loan, it's pretty much the same thing, except instead of the average daily balance, they take the statement balance and then multiply it by the interest rate and divide it by the 12 to get the monthly interest, right? They're very, very similar in how they're calculated. The word amortized, what it really means is that the amortized loans means the debt is going to go down to zero at the very last payment according to a schedule, right? So the opposite of that would essentially be like a hard money interest only loan or a loan with a balloon. Because if you let's say you have a balloon, like a 5 year balloon on a note, that means that 5 years the balance doesn't go to zero, which means it's not amortized, right? Amortized means that you have equal number of payments, and then the very last payment makes the loan balance go to zero. That's all it means. Now, if essentially the line and the loan of credit, I'm sorry, I'm getting my words mixed up. If the loan and the line of credit interest is calculated the same, why in the world would you use, let's say, a 9% interest line of credit to replace a 3% mortgage, right? It's not gonna work out. And the reason it's not gonna work out is because the amount of cash flow that you get for paying it off is so little. And let's just go ahead and do a demonstration right here where we have someone who has a line of credit, right? I'm sorry, a mortgage, and let me actually do this, 870.41, a mortgage, and they get the idea, okay, let me replace this 3.25% mortgage and just put it in a 9% line of credit. Well, guess what happens to this one? First of all, let's calculate the cash flow index. So it's 200,000 divided by 870.41. Well, the cash flow index is 229. That's way higher than the 100 that that you're told not to. That's considered to be an efficient loan and that you shouldn't pay off, right? So it says by knocking the inefficient loans first, you free up a ton of cash flow to work up other debts. So let me go back here. But what I'm saying is that this cash flow index number is very, very high, which is why you don't want to pay it off early if you have, let's say, a couple of debts, right? But when it just comes to one loan and you're saying, oh my goodness, I'm just going to put this thing into a line of credit, let's go ahead and do this right here, 20000. And when I move this 3.25% mortgage in a $200,000 line of credit, okay, so I'm going to go ahead and put this to zero. Then our cash flow is going to be $3,000, so meaning it's going to go down $3,000 every single month, right? So let's go ahead and just do our same calculations right here. And then now I'm going to go here, plus previous month's interest minus our cash flow, which is $3,000, right? And then let's go ahead and calculate the average daily balance. Do this, multiply it by 0.09, which is 9%, and then divide by 12. Okay? Now let's see how long it takes for this line of credit to pay off. Okay? Let's see how long it takes for it to pay off. Doing this method of replacing the entire thing with a line of credit. Okay? So this is going to take 93 months. So 93 months. And we got to put in the, hold on, let me do this. 93 months. Okay? And we got to get the sum of all the interest that we paid, right? So let's calculate that sum. So this one is 76K of interest. Okay? 76K of interest. Now, luckily, we have a velocity banking calculator that I got from Renatus, which is where I originally first learned velocity banking. And I remember when I took the class in 2017, they said something along the lines of if you do chunking, it's a lot more efficient than replacing the line of credit or the mortgage with the line of credit. And I think they're re-updating the class in Renata. So if you don't know what Renata is, it's an educational company where I first learned velocity banking from, and they have this velocity banking calculator, right? So let's just do this. Let's just do a quick comparison, see if this is similar to what I get in the calculator. So if I have $200,000 loan, $200,000 loan, 3.25%, 30 years, 870.41, and let's say I replace this whole thing into a line of credit at 9%, right? And we have our income minus our expenses. And let me just check something if the numbers look correct. Okay, so income 5,000, expenses 2,000, right? Okay, so that makes sense. All right. So now let's take a look at the here. So we have somewhat similar numbers. I think my numbers are a little bit more conservative. So what's 93 months? 93 divided by 12. That's 7.75 years. The Renatus calculator says 7.9 years and 81 grand in interest, right? So it's actually saying in the Renatus calculator this is more expensive, right? Whereas my again, I'm pretty sure there's some nuances how this is calculated, but let me show you in the back end what the calculator does. So basically, you have a loan balance of $200,000 here. You move this to the line of credit, and then it calculates it on the daily interest. So it's probably more accurate than what I'm doing. And then your income comes in, your living expenses goes out, and so it goes down, and then so it just sums up all of the daily interest. So if I go down here, and then you take a look here, we only potentially save $31,000 of interest, right? Now, if we do chunking or extra payments, so let's say we do $5,000 my goodness, coughing. 22 grand of interest that I would potentially pay compared to 81 grand, right? So this is why, folks, you don't want to move the entire thing into the line of credit. And whether you do extra payments or chunking, it's up to you. I personally think that when it comes to you having one mortgage as your only debt and then doing the strategy, yeah, it will save you a ton of money, but it won't save you that much money if you replace your entire mortgage with the line of credit, right? So you can see from my manual calculation that here it says if I do chunking, I'm going to pay about 22 grand in interest. But here, if I do, what's it called? Replace the entire mortgage with line of credit, it's at least going to be about 7 years and at least around 70 to $80,000 of interest, depending on what model you're doing. And actually, let me do this 200000. Yeah, 81 grand. Ew, gross. Yeah, I'm not doing that. All right. Well, hopefully this made sense. And let me just go back here. So again, I probably need to make another video about how like the interest is calculated on a loan versus line of credit. It is pretty much the same. The only difference between a loan is that you can pay up to, in my experience, you can pay up to 15 days late and they still calculate the because it's not based on the average daily balance, it's usually based on the loan statement balance. You can pay up to 15 days late and you're good. But again, don't believe me, call your lender to verify that you can actually pay up to 15 days late. I always pay 11 days late and they said it's okay. um, but I noticed that no matter how, if I pay with any time within that 15 late day period, the loan interest is calculated the same. So it's not exactly the same as the line of credit, which is based on the average daily balance. It's more based on the loan statement balance, but they're both simple interest. And compound interest, when it comes to debt, only happens is when you make late payments because interest will accrue on top of interest. Whereas if you're making the payments, um, if you're making the payments on time, then there's no compound interest. Okay, well, I know that this is going to make a few people mad because I made a video similar to this, and they're like, "Don't you know that's wrong? You should." I totally disagree with this, and I don't know what you're talking about. Listen, what I'm saying is that if you want to replace your mortgage with the line of credit, your entire thing, look at this number. That's a huge number, 81, right? And look at how much interest you save, 30 grand. Whereas if you do the chunking method, or you can even do extra payments, look at how much it says you might save, right? Like you want to pay 80 grand or 22 grand? It's up to you. I mean, if you want to make stupid decisions and replace your lower interest rate loan with a higher interest rate line of credit, the entire thing, that's up to you. And take a look at this. If I do 30%, let's say I had a 30% credit card, it goes up, but it's only about 6 grand compared to if I do 9% and then I replace the entire mortgage, 200000. Look how much that goes up. Even a 30% credit card, like a 30% credit card with chunking will save you more money than replacing the entire thing on a 9% line of credit. Okay? So I would consider this to be the number one velocity banking myth. And when it comes to velocity banking, I'm not just seeing like, oh, lines of credit good as like a benefit, right? What I'm seeing is that the goal is to maximize this thing called the cash flow number. And usually that happens when you have several debts, right? And so, I always show you, oh, put all your credit cards into the line of credit, and then you'll see that cash flow number immediately jump up just because credit cards take up a lot of cash flow just because the interest rates are so high, right? Or that's at least one of the reasons. And the mortgage you want to leave for last because the cash flow, again, look at this cash flow index number over 200, it is very low compared to the loan amount, right? So just something to be aware of. But yes, I consider this to be the number one myth of velocity banking, that all you got to do is replace any loan, including a mortgage, with a line of credit, and it's going to be like the best thing ever. But it's not. Okay. Well, all right. This is Korean Atlanta Mentorship. I'll probably make more videos about this. And again, Velocity banking has its strengths, but sometimes I feel like it's over exaggerated what its benefits are sometimes on the internet. But it doesn't mean it's not a powerful tool. It's a very powerful tool. Okay? All right. Well, have a great day, everybody. Good night, and we'll speak next time.